Welcome everyone, I'm Matt Franklin, your portfolio coach, and this is Portfolios 400 Investment Strategy. This is my favorite lesson because we get to walk you through important topics like determining your strategy, where we walk you through the results of our testing and our recommendations. Then we provide some awareness to popularity-based trading, or what you need to know when day trading, and have some points of awareness if you decide to take this path. Then we cover some additional considerations like liquidity and different types of holdings. And we get into hedging and what entails with options and futures. And from there, we'll touch on some elements of retirement planning, and then we'll wrap it up by covering methods for maintaining wealth. When determining your strategy, there are a few different things that you want to consider when getting started. First off, you really want to try and understand your goal. Obviously, everybody wants to make money, but is there a specific goal that you have in mind with investing? Like, are there certain types of stocks that you want to invest in? Are there certain ways that you want to manage your portfolio? Or do you have a certain threshold that you want to maintain with how frequently you're interacting with it? Some other factors to consider are like what type of risk level you have and how much risk do you want to take on. Leveraging different metrics will allow you to do that. But is there a certain metric that you'd prefer to use? And then different metrics support different strategies, but think about if the ones that you want to use actually align with your goals. And as we cover these concepts and walk you through this lesson, those are some of the questions that we hope to help you answer. Just as a reminder, the metrics that we have available in our system and test are expected return, alpha, Sharpe's measure, trainer's measure, and the overall average. At this point, we've been able to come up with some level of understanding of when using these metrics works, but it was really, when we began to expand into other questions like what is the best historical time period to use for calculating these metrics, how many stocks should you include in your portfolio, what optimization frequency works best, and what sort of economic conditions produce the best results for each. So we investigated those questions and then we graphed our results. So let's take a look at the results of our testing and go through each metric. Starting with expected return. In the upper left corner, we have the first question that we tested: how many stocks should you include in your portfolio? You can see for expected return that actually having fewer stocks in your portfolio performs the best, although it doesn't really look like there's a bad option here since all of the portfolios perform well. If you think about the stock selection with expected return, it's just based on stock price performance and who's been performing well. And if you only have a few of them in your portfolio, you're less diversified, but taking on that added risk allows for those higher returns. So that's really what you're seeing here, that all of the portfolios performed well, but if you're someone that only wants to invest in only a few stocks, this might be a good strategy for you. In terms of the optimization rate and how frequently you should be rebalancing your portfolio using this strategy, you can see that bi-monthly or semi-annual are the returns that jump out here. So that means that about every 2 months, or at a minimum every 6 months, you're checking an optimizer to see if your portfolio should be rebalanced. Now, our testing does show that you can rebalance about every 2 weeks or so, but I would stay away from a week or less, or from balancing your portfolio only once a year. Those options tested below the market, and again, optimizing every 2 months perform the best. Then in terms of the historical time period that you can use, which again is just referring to the range of data that you're using to calculate your estimated return, you can see that it continues to go up as the total amount of historical data increases. So when you get to about 10 to 15 years, you can see that those are really some of the best performing portfolios. And if you think about that, that just means that over a 10 or a 15-year period, the stock that receives the best grades had really well-performing expected returns for a long period of time. And that will help you find companies that have produced stable growth over that time period. The last chart we have here shows the annual performance for our expected return portfolios over the entire testing time period. You can see the market performance by year with the black bar, and then the gold bar is the performance for the expected return portfolios. You can see that some of the years had some fairly extreme returns, and in 2018, 2019, and 2020, some of the selections that were made performed really well, but I would consider those more as anomalies than something that I would expect to repeat. Many of the other years are much more in line with what you'd expect to see here. Anyway, I just thought this was an interesting chart, and I wanted to include it so that you can see the performance over time to help you understand which metrics work best for different economic conditions. Our plan here are to update these studies more frequently and to post the results on our sites so you can see what's working. In terms of alpha, as far as how many stocks you should include, you can see that you should have at least 12 in your portfolio, and actually 30 tested the best, but keep in mind that 30 can have a large workload that comes with it. In terms of the optimization rate, it's a little more short-term. Biweekly and monthly tested the best, so about every 2 to 4 weeks you want to optimize and rebalance, which makes sense, when you look at historical time periods that you should leverage. The testing indicated that a shorter set of returns like 90 days or 1 year perform the best. And if you think about it, that makes sense. Alpha is a metric where it's identifying a return that's not produced by the market. So if you're trying to use alpha as your strategy for identifying good investments, you're going to want to look more at investments that are doing well in the short term. So by identifying assets that are doing well over the last 90 days or the last year, that appears to give you the best chance for capturing returns when using alpha. Then you can see the historical performance over time here as well. For the most part, alpha performed well in years of economic expansion and growth. You have to be careful, though, in years where the market performance is down, a lot of investors will move to more stable long-term investments, and short-term investments can end up seeing losses. When it comes to Sharpe's measure, this tends to be what investors on Wall Street like to leverage when they're constructing their portfolios. Now, not necessarily all of them, but a lot of the ones that are really into the math and the statistical side of investing, they tend to appreciate Sharpe's measure as a metric for understanding who's really creating value out there. I also think that it tends to be a metric that a lot of academics tend to use for portfolio construction, and the results here reflect really what I was taught in class, which is that your portfolio should include about 8 to 12 stocks, and you should optimize it about every 2 to 4 weeks. In terms of the historical time period, this shows that anywhere from a 5 to a 10-year range works well, with 8 being the best. And you can see that in general, Sharpe's measure tends to mirror the market returns. Now, there are certainly years where there's a little more or a little less than the market, but for the most part, Sharpe's measure just helps you identify stocks that have been stable over a long time and are consistently producing a premium for the risk that their investors are taking on. Now, it's true that you can earn higher rates of return with other metrics, but Sharpe's measure-based portfolios tend to be more stable, and they act more like index funds. Then we have Trainer's measure. This metric represents the premium that you get for every movement in the market. So stocks that do well during volatile times are typically the ones that are identified here. These stocks can occasionally produce some extraordinary returns, but they also tend to be a little bit riskier, and you need to pay more attention to their beta. In terms of how many stocks you should have in your portfolio, with Trainer's measure, you only want to use a few of them, like 5, or a lot of them, like 30. And that's because you're trying to leverage that variability and capture that return. And by only having a few of them, you can do that, but also by having closer to 30 of them, really what you're doing at that point is you're building more of an index fund and you're capturing your return that way. So when it comes to the return time period, really 90 days and 10 years perform the best, which really the short-term view, in my opinion, is a little bit safer. Now, that's not to discount the fact that if you have a stock that's performed well over 10 years, certainly that could be a great selection as well. And then in terms of how frequently you want to optimize your portfolio, our tests indicate that you want to be more in that 4 to 8 week range. And you can also see here the historical performance and the returns using this method over the time period. You can see that many of them are quite high. And that has a lot to do with the risk associated with these stocks. So if you do go down this route, it is a little bit riskier. And like I said a moment ago, I would just pay attention to the beta of the stocks that you're considering. Just do that to make sure that you're not taking on any unnecessary amounts of risk. And if you end up building a portfolio, with a beta of 4, you need to understand that your portfolio can swing dramatically from day to day, and that's not something that most people can stomach. So when you take a snapshot in time, like these results here, what the charts don't show you is how much the portfolios were going up and down on any given day. It just shows you the final performance. So don't get overly excited and take on a whole bunch of unnecessary risk. Do the best that you can to mitigate the risk before jumping into the portfolio. Taking a closer look at the average, in my opinion, this is one of the best ways to find out if a stock has good metrics or not. Since, this is the average of the other 4 metric rankings, the stocks ranked high here had a high-performing expected return, alpha, Sharpe's measure, and trainer's measure. So when you're looking at stocks using this metric, you're going to generally find stocks that are a little bit more stable. In terms of what our testing found, you can see that with the historical time period, the returns go up when there's more time added. 8 years had the best return. When it comes to optimization and rebalancing your portfolio, doing it monthly resulted in the best return. And if you think about it, looking at your portfolio about 12 times a year really doesn't take that much work. Something else that I want to mention is that you can include a lot of stocks with this strategy. The recommendation shows anywhere from 12 to up to 30 can work out well. So this strategy is one that if you have a lot of stocks that you're interested in investing in, or if you like to collect them over time, this grade can be a good point of reference. Also, I like to reference the average when you're already using another strategy, just to see if the stock had performed well across the board. Coming back to our strategy recap, hopefully these results make a little bit more sense now. Depending on how you're looking to invest, there are a variety of different strategies that you can deploy. And when I first started down this path of testing all of these things, I didn't think I was going to find results like I did. I thought there might be some slight differences, but this just goes to show you that your strategy really can make all the difference, and that these metrics can be very useful to you, but in certain ways and when viewed under the right circumstances. So honestly, I was surprised when I saw all of this, and it's the reason that I started working on this training program. And for the future, our plan is to continue to update our studies and to provide those results to our members. We want you to not only be educated on what works, but to have the best available data and reporting to help you with your research. And really, these are the strategies that we support. The next section in this training, we get into day trading, and especially if you're new to this, that's not really a path that we're recommending. Before we move into that, let's just revisit this concept once again. Hopefully this method makes sense to you now, and you're beginning to think about how you want to manage your portfolio. As we walk you through the remaining lessons, start to think about what you want to invest in and why. We'd recommend keeping a notebook so that you can keep track of your ideas and record any feedback that you want to reference later on. All right, it's time for our first question for this lesson. So what is a good metric to leverage for a short-term holding strategy? Is it A, alpha, B, Sharpe's measure, C, the grade average, or D, trainer's measure? The answer is A, alpha. Trainer's measure can also be a good one, but alpha is more commonly used. Okay, now we're going to get into day trading. For the purposes of this training, we call it popularity-based trading, and we'll talk more about some of the ways that you can leverage the daily happenings of the market. But before we jump into that, I want to talk to you about what happened with GameStop a few years ago, and the fact that it's easier than ever to impact the market as a retail trader. Now, first off, I just want to say that there's a wonderful docuseries that Netflix put together called Eat the Rich, the GameStop saga, and this goes into much greater detail about all of this. There are also other materials that are out there that you can read too, and you can go, of course, to Reddit and Wall Street Bets if you'd like to see everything for yourself. What we want you to learn from what happened is a concept called short interest, and how that works. And short interest relates to short selling, which is a concept that we haven't covered yet. And personally, I'd rather not bet against someone, but that's just my preference. That said, I still want to explain what it is and make sure that you have an understanding of how to leverage short selling if you want to make that part of your strategy. As you buy assets, typically it's with the view that you're going to hold on to them for a while. With short selling, you're making a bet against the stock. Essentially, you're saying that the company is overvalued and that its price needs to go down. Or you might believe that the market is going to go down and that it's a good time to bet against the market. Now, just as a point of awareness, over a 10-year period, the market tends to produce a positive average return, so betting against the market doesn't usually work out. But over a short time period, it can, and it does for some investors who know what to watch for. Short selling is a more common strategy at hedge funds than it is with individual investors, and a lot of times investors will identify a company whose stock price has continually fallen, and after examining the company a little closer, if they agree that the company is likely to fail or to continue to lose share price, they'll take a short position, which is a bet that the price will go down. Now, they're able to make that bet by shorting shares of someone in a long position. And when the stock price falls, the losses of the person in the long position go to the person in the short position. This can work out well as long as the price keeps falling. And in the case of GameStop, their price fell pretty steadily for several years, and a few large funds had started taking short positions against them. When they viewed GameStop, they saw it as just another brick and mortar being overtaken by technology, and as games transition to online play and users can just unlock and download their games, there's no more need for a physical store to go to. Now, you might disagree with me based on the used market, but as far as new games go, it's all digital content anymore. And a long time ago, I was actually a GameStop employee. I loved that place, and it was an exciting place to be. But everything has its time, and really that was their bet. They just felt it wasn't going to exist much longer, so why not bet against it and earn a little bit on the back end? The thing that you need to understand about going short is that when you go long in a company, the most you can lose is your investment. So if you put $100 into a stock, the most you can lose is $100. When it comes to going short, the problem is the amount that you can lose doesn't have an endpoint. It can continue to grow, and at a certain point, you have to accept that you made a bad investment and cash out of your position. So using that same $100 example, if you take a short position and the stock instead goes to $200, now you owe the $100 difference when you cash out. And that $100 difference is called short interest. Now, that example might be pretty simple, and it might not sound so bad at $100, but when the stock is trading at $5 a share and you're in a short position, and then new investors jump in and suddenly it's trading at $105 a share, well, if you took a short position on 1,000 shares, where the long position in theory would have cost you $5,000, now you're looking at a loss of $100 a share over 1,000 shares, which is a loss of $100,000. So that's what we're trying to help you understand with short interest and how it works. Hopefully that also helps you understand why it's not a strategy that we recommend for new investors. What got some hedge funds in trouble with their shorts at GameStop is that the share price disparity and the quantity of shares that they had shorted were significantly larger than that example. And as a result, their short interest position built up to a level where it could bankrupt their fund and force their clients to lose all their investment. Now, like I said a moment ago, I worked for GameStop. Now, that was back in 2006, and I was in college at the time. I loved working at GameStop, and you always had such a diverse group of customers, and you never really knew what sort of questions you were going to get asked next. A lot of those questions were about older systems, so you can probably understand that some of the other associates and I would talk about starting our own stores and capitalizing on that market that GameStop didn't serve anymore. Now, what I'm getting at is that there's a certain nostalgia when it comes to video games and people's positive memories that they have associated with playing them. So to me, I think those positive memories had a lot to do with how all of this happened, And for the folks that took a long position, their opinion was and still is that GameStop is a good investment. To be clear, the hedge fund's large short position existed for several years before it generated interest by the online community and Reddit, and more specifically a group called Wall Street Bets. They started to look more into why someone would take that position, and what they found was, in their opinion, a heavily undervalued company and an opportunity to earn a return off the backs of the hedge funds. So as a result of their posts and discussions, it brought on a lot of interest to the stock, and then the stock price started to rise. It caught the attention of angel investors, and then suddenly large amounts of capital began flowing into long positions for GameStop stock. And as the price took off, retail investors were noticing, and they wanted to jump in on the action too. And when, demand increases for a stock, the price will continue to go up. Now, this didn't build up overnight. There was a lot of momentum that built up over time here. But what ended up happening is that the short interest grew to a point where it was going to bankrupt the funds. So what then happened was even crazier, because on the day that the price started to really spike and go up, in order to avoid a total collapse of these funds, the market makers behind Robinhood actually paused trading. It worked in the short term in terms of stopping the price increase, and on that day the price did fall back down. But there were a lot of questions for why market makers were allowed to do this, and they even came back and took on lawsuits at the individuals who took the long positions in GameStop. In fact, those folks that took those long positions, they had to go to court and they had to defend why they took those positions. And ultimately, you could view this from a few different perspectives. One, Wall Street made a bad bet, and the funds should have failed. Two, the Redditors, in your opinion, did it intentionally to ruin the funds, and they almost pulled it off. Or three, you can understand that this was just a moment in investing history where differing opinions caused an unexpected event. The point that I'm getting at by introducing you to the GameStop story is somewhat of a cautionary tale. Anyone can lose, but historically the retail trader was never well funded enough to make an impact in the stock price. Today, with social media, working together as a community is easier than ever, and the power of the people's will, it can become the way. It's also a reminder that the big and powerful are the big and powerful, and if you try to take them down, they will find a way to outsmart you and to continue to win. But don't let that discourage you. With movements like Occupy Wall Street and through events like this, hopefully you can see the power of stock ownership and the effectiveness of working together as a community on a common goal. So hopefully you're enjoying this content and you're finding it useful. My goal with this program has always been to help you understand a little more of what the academics teach finance students, so that way you can leverage those things for yourself. What most academics do not teach is day trading, and it's not really something that we recommend to you. Like if you're an individual with a job at a corporation and you think you're going to listen to a couple of podcasts and start doing some day trading while at work, you need to understand and recognize that your job is going to take up a lot of your time, at least if you're good at it. And things are going to pop up unexpectedly throughout your day, and your focus will be elsewhere. So you're going to miss out on those opportunities that you're looking for from a day trading standpoint. To me, day trading is something that if you want to do it, you need to be fully dedicated. It has to be everything that you're doing throughout the day. If it is, then yes, I'd agree that it can likely work for you. But in general, and for the vast majority of people that are listening to this, you have other responsibilities throughout the day, and I'm sorry, but if you think you're suddenly going to pick up day trading and make a bunch of money, the likelihood of that actually happening is pretty low. Now that said, I still know almost all of you are going to try it. The idea, that someone could make an investment and suddenly become wealthy is very appealing. And with all of the media out there today, there are people out there that have had success, and people are drawn to them because they want to find out how to mimic that. Now, what a lot of those people do or preach is to trade off of the peaks and the valleys throughout the day. Now, there's this expectation that throughout the day there are going to be moments with lows and moments with highs. And if you jump in and out at the right time, you can make your earnings that way. And a lot of people that do this will also specialize in a certain area or in a certain stock. And it has more to do with how well they know that market or that stock. That also becomes a major factor as to why that person knows when to jump in or jump out. And from the outside, they make it look easy, but the reality is most people don't make as much money off of day trading that they otherwise would by investing in an index fund. And of course, our recommendation is to learn how to build a portfolio that acts like an index fund. So hopefully by seeing that difference, it helps you understand why we shy away from recommending this path. Now that said, if you want to do this, you'll want to study a particular stock or a particular industry and figure out what makes that stock price go up and down. And when do the reactions come from the market and what's going on in the market when it is going up or down. Even more so, you want to attend earnings calls to understand what's going on with the companies and what they are saying in response to events in the market and to questions about their company and their stock's performance. By doing things like that, you'll have a better understanding of why prices are moving the way that they are, and that will lead you to the performance indicators that you need to watch in order to understand how to make your predictions and ultimately your daily bets. Keep in mind, this path requires a lot of time and concentration. There's also a high transactional cost, so if you're making a lot of trades throughout the year, keep in mind the taxes that you'll have to pay on your gains, and if your brokerage firm still charges you for the trades, find another one. There are a lot of great trading platforms out there that will allow you to trade for free. So if you're someone that wants to do this, certainly it's a path that you can take. We just recommend that you find some mentors, some folks that already do this and are successful that you can learn from. And whether that's an individual investor from your community or somebody online that you follow, you always want to be willing to learn and to find others to learn from. It will only help you, and you might end up building a whole new community around you in the process. I once went on a wine tour, and I'll never forget this. Somebody asked the winemaker, what makes the best kind of wine? And he responded that the best kind of wine is the wine that tastes best to you. And that's always stuck with me. If you're going to be successful doing this, find something that's special to you and concentrate and spend your time researching that. If it's already an interest of yours and something that's already really high up on your radar, meaning that it's something that you already pay attention to, those will be the areas that work for you because you're already focused on them. There are a lot of stocks out there in the market, not just the big blue chips that you generally hear about, and you might even find that some hobbies that you have, there are entire industries that exist behind them and have publicly traded stocks that you can invest in. And if you really focus on a couple of those from a day trading standpoint, you can then generate your returns from there. Then you just want to find a good news feed where you can get all of that relevant information. You also should connect with those companies on social media and pay attention to what they're communicating and which channels of communication that they prefer. Now, LinkedIn is actually a great news resource because it's a place where companies actively recruit, so they always want to brag about their latest wins and achievements. Now, that's not a plug for LinkedIn, but there are a lot of resources like that that are out there. We're just recommending that you get the latest and greatest information directly from the source. And keep in mind, you can also follow a number of CEOs and high-level individuals at publicly traded firms, and you can monitor what they're sharing as well. At the end of the day, corporations are people. And I don't mean that from the legal sense. I mean that they are a collective group of people working towards a common goal. So sometimes knowing which ways to trade all comes down to knowing the right people and how they make their decisions. And the last point that I want to make here is about hedging, and we'll get more into that in a moment. But if you're taking on risky investments while day trading, you should also consider offsetting some of that risk by investing similar amounts in less risky investments. Now, don't discount meeting with financial professionals about day trading. They also likely won't recommend it, but they can recommend products for you to help offset that risk. With that, let's take a break for another question. And this one pertains to day trading. So what do you think is the best source of information for day trading? Is it A, press releases and social media? B, annual reports and historical metrics? C, corporate documentaries? Or D, your local financial planner? Now, when you're trying to day trade, it's A, press releases and social media that will be the most useful to you. Now, it's not that any of these other things aren't helpful. It's just that day trading is more about understanding the moment and the happenings of that day rather than what makes a good long-term investment. These next few chapters are areas where I'm no expert. I do, however, want to cover them because these are things that you need to be aware of that are available to you, and some of you will learn to leverage these tools and use them to your advantage, but they're not for everyone, especially those new to investing. Now, the first topic that I want to discuss is portfolio leveraging. So, what exactly is leveraging? Say, for example, you've got a portfolio with $20,000. Now, some firms will offer you a line of credit worth up to the value of your portfolio. In other words, in our example, we could take on another $20,000 worth of debt. Now, you might say that sounds incredibly risky, and while you're right, here's what they're thinking. Rather than invest the $20,000, if you're investing $40,000 and earning 8% while paying a lower rate on your debt, you can then use that debt to actually get ahead and make money because of the compound interest working off the larger amount of money that you're now investing. And during bullish times, this strategy can work out quite well, but it's hard to tell how long those good times will last, so taking on debt can become risky. Now in this chart here, this is an example of what it looks like when someone with a $200,000 portfolio invests just the $200,000 versus someone else that chooses to fully leverage their portfolio and take on another $200,000 worth of debt. At the end of the 20 years without leverage and earning an 8% return, you would have about $1 million. Now if you took on the leverage and paid an interest rate of 6.9%, by the end of the 20 years, the loan will be paid off, and if you earn the same 8% return, you'd now have about $1.6 million. So to be clear, you would end up paying about $420,000 in interest to get a shot at an additional $587,000 in income. And while you do get a 58% increase in your overall end result, you have to keep in mind that market conditions are not guaranteed. Investment returns are not guaranteed, and just as easily as you can make money, you can lose it. And the market will have down years, and you might find yourself having to pay interest on that loan while you're also losing value in your portfolio and not generating any income in order to make the loan payment. Certainly, there are safer strategies, like if you can get a loan at an interest rate below a treasury rate. That can lead to safe returns, but this is just something that we want you to be aware of. It's not something that we're recommending, especially if you're new to investing. Use discretion, and please don't take on any unnecessary risk if you can't handle it. This exists as something that larger funds and investment houses will leverage as part of their strategy. You as an individual have to be careful because you can very quickly go bankrupt if you make the wrong calls. Now, if you want to use leverage, have some discussions with a financial professional before taking on any debt. It's up to you if you want to leverage this strategy, but make sure to surround yourself with good people and not just salespeople trying to profit from you. Liquidity is a reference to how quickly you can turn something into cash. And while cash is king, some other examples of highly liquid assets are treasury bills, bonds, and some would also consider like gold or silver bullion. And silver coins are more commonly accepted for personal trade, but buyers for gold are really not that hard to find either. Assets with low liquidity still have value. They're just harder to find buyers for. So, if you need to turn something into cash, it just takes a little bit longer. Now, here are some examples of low liquid assets. This would be owning things like your family home or a farm, maybe an automobile, a boat, an RV. Of course, those things can depreciate. You might even consider artwork or certain antiquities. Now, these are all things that have value. They just take a little bit of time to find the right buyer. And as you build up your investment portfolio, some investors also have commercial real estate and will own businesses. You'll hear a lot of investors talking about commodity prices going up and down. And if you're going to invest, you should pay attention to commodities. Commodities are inputs needed for businesses to provide you with those end products that you purchase today. Now, these can be anything from basic raw materials to food and grain, even things like gases or gems and diamonds, stuff like that. So knowing what raw material inputs are used by your investments will help you better anticipate profits and whether or not your investments will continue to perform like they have. If raw material prices are increasing and corporations are not increasing their prices, that means their cash flows will suffer and so will their stock price. If they're passing along the price increases to the consumer, then the consumer can demonstrate a willingness to pay for it, and you get a better understanding of what the market can accept. So we tend to reference commodities as a way to understand the movements in stock prices and predict future outcomes. Now that can include predicting things like mergers and even industry consolidations. Now purchasing commodities is something that you can do, and some traders will play in this field. Futures are primarily meant for corporations for purchasing raw materials, but they are often traded due to their fluctuating values. Just know they aren't generally meant for retail traders. If you do purchase commodities and hold on to the futures contracts to maturity, you will need to take delivery. And most retail traders don't have the space to start trading in physical commodities. Large funds can find ways to manage this, but it's going to be difficult for you as an individual. So if you're using them as an investment vehicle, then keep in mind that you have to sell them before their maturity date. Now, we don't encourage new investors to invest in commodities. We just recommend that you have an awareness of their price movements so that you can better understand your investment's performance. So let's talk more about futures, options, and hedging. Like, what does it mean to hedge? What is a future? And what are options? And should you include these in your portfolio? Well, hedges are basically a bet that's the opposite from a current bet that you have. It's generally done in a way that if you're taking a long position in a stock, but you think that over the short term maybe they're not going to perform very well, so you take a short position on the stock as well. That way, if the stock does go down, you can still make money while your long position is losing. So when large investors do this to minimize any potential losses, and they are generally handling large amounts of capital, and even in the worst financial conditions, they need to protect their clients' money and make sure that there are opportunities to still engage with the market and come away with gains. While that might sound great, these strategies can get tricky. So if you're new to investing or if you're a retail investor, we're not recommending that futures and options are something that you'd want to leverage. If you want to hedge by taking a short position against a long position, that's not a big deal, but as we talk more about futures and options, you'll understand why this is something that only the prepared should really be utilizing. And you'll find people all over the internet that will talk about how much money they made off of futures and options, but I'd encourage you to ask them about their largest losses and see what you think before you decide to jump into this game. This is more designed for institutional investors, but trading platforms do allow you to buy futures and options, so we just want to spend a little bit more time covering them for your awareness. Now, options trade in multiples. For example, they'll trade at ratios like 10 to 1, 50 to 1, 100 to 1, or 200 to 1, which means that if you have a 2-cent price movement and you have a 100 to 1 option, then your option will move by $2. So you can imagine when there's major market swings, your options can have dramatic price changes. Now that can lead to very quick riches, but it can also lead to total loss. So when you're trading options, balances have to be cleared out at the end of every day. So if you have a $20,000 bet on some options and they make some movements and the movements lose $12,000 on that day, which is totally feasible, that balance gets cleared out of your account on that day, and the next day you only have $8,000 available to invest. So you can understand then when somebody who just lost 60% of their portfolio will then take an even riskier bet to try to win it all back, and what ends up happening is they lose it all, or worse, they end up owing the bank money. Options trading can be very risky, and if you're not properly diversified, you can very quickly lose a lot of money. And certainly, it's not something that we recommend you engage with as a retail investor. I know individuals whose families have lost their entire fortunes, like large ones, because one family member started playing around with options. So just be aware that it's something that you really want to study up on and have a good understanding of before you begin to take this on. And with futures, like we talked about a moment ago when discussing commodities, these tend to be products that are more designed for corporations to engage with in order to secure raw materials. For example, if you're a corporation that's delivering packages and you need to purchase large quantities of fuel for your delivery vehicles, one way that you can ensure a stable average cost of your fuel is by purchasing futures contracts to guarantee that you can take delivery at a certain price. Then, as the price rises, the value of that contract increases. And you have two options. You can either hold on to that contract until maturity and take delivery of the fuel below market value, or you can sell the contract and take a premium, and that premium you receive for that contract, you can apply to offset the rising cost of your fuel, making your average cost of fuel more acceptable. So large institutional investors will also use futures because if they think that the commodities prices are going to continue to go up and that demand isn't going to soften, they'll go ahead and buy those futures and potentially even take delivery on them if they feel that holding on to those goods for longer periods of time is going to be worth it. And for corporations that are publicly traded and need to deliver on their forecast to Wall Street, this type of hedging allows them to maintain commodity prices for longer, and it gives them a chance to deliver on their forecasts while still reacting to market conditions. Now, that's really what futures and options are to help corporations stabilize their inputs so that they can have a better chance to deliver on their promised outcomes. In addition to using financial products for hedging, some people prefer physical gold and silver bullion. And while the value doesn't fluctuate as much, it's more of a hedge against a currency rather than an investment. For example, many people online buy into what we'll call the SHTF theory. This theory would involve the collapse of our society, at least in the way that we currently know it, and wealthy individuals want a way to protect themselves and their family's wealth in the event of this type of collapse. So by purchasing gold and silver bullion, this is generally done as a protection to be able to maintain your status within society. People who do it thinking that they will actually trade these coins today will likely run into difficulty doing so. Silver coins are easier to use since one coin is worth about $20 to $24, but gold coins aren't as commonly traded. Now, still, physical gold and silver can be a great way to ensure stability in uncertain times. So if you're buying gold or silver, you want to make sure that you're getting it from a good, reliable source. There are lots of places that like to advertise, but there are also many people out there that will try to take advantage of you. Also consider where you want to store these metals. You can keep some of them in a safe at your residence, but mainly you'll want to keep it elsewhere, like in a safety deposit box at your bank, or if you like watching spy movies, apparently lockers at bus and train stations work pretty well too. No, I'm just kidding. Don't use a locker in a public place. I also wouldn't recommend burying it in your backyard either, but it is your money, so it's up to you what you want to do with it. Also, unlike your stock investments, don't advertise this hedge to your friends. They might not be a threat, but they could be bragging about your stash one day when someone a little less friendly overhears. So use discretion when talking about this and when showing off any bullion. And keep in mind that when the market goes down, people are less enthusiastic about the future, and that's typically when gold and silver prices go up. So if you're in good times and precious metals are priced low, you may consider picking some up. Market conditions are always changing, and if there ever was some type of currency collapse, then you're protected and you can maintain your position within society. Now, some other savings products that are out there that can be pretty beneficial to you are things like college savings plans. These plans can be something that you contribute to throughout your child's life, and they're something that a lot of states in the US also offer tax rebates for making contributions. So if you're donating to a college savings plan, sometimes there's a portion that you may be able to get back on your tax return each year, which is pretty cool because it's essentially free money and it can compound and help your children out in the future. Another savings option to be aware of are health savings accounts. You have to have a high deductible healthcare plan in order to qualify, but this is another way to take some of your money from a pre-tax standpoint and to contribute it into an account to use for healthcare expenses. The accounts act as a way to help you offset some of that higher deductible and to help you cover other out-of-pocket expenses. And even if you don't use the funds, some accounts allow you to invest the money above a certain balance, helping you earn an even higher return on your pre-tax savings. Money market accounts are offerings that you can find at some banking and investment institutions. Essentially, they're just savings accounts that offer a rate more similar to a CD. They typically have minimum balance requirements, but these are great accounts if you don't want to tie up your money in a CD or a treasury, and it keeps it fairly liquid and you can earn a healthy interest rate. Then there are fixed income annuities. You can get these from financial institutions and some insurance corporations. These are typically low-risk products with a guaranteed income. A lot of people that are in retirement or are about to retire generally are encouraged to consider these. It's just a way to make sure that you're going to have a stable income over time. Now, a criticism would be that they don't offset inflation very well. And to give you an example of how one works, say you have $100,000, and rather than investing it and attempting to get a 6% return every year, you go to an insurance company and they give you a policy where they guarantee you a 5% return and a monthly payout over the next 30 years. To be clear, at the end of 30 years, it stops. There's nothing to keep you from reinvesting your monthly payments, but most people use this as a type of product to help cover bills during retirement. Fixed income annuities aren't products that you're going to buy and sell like stocks, and you can't get in and out of them as easily as other accounts. But for people at certain stages in their life, they can be a great way to secure their future income and allow them to contribute to their risk-free portfolio. So if you're struggling with what else to consider for your risk-free portfolio, or if you're at or near retirement, you should definitely consult a professional to see if an annuity is the right product for you. Getting into retirement planning and some of the basics that we want to cover here, we don't get too in-depth, but there are a few topics that we want to cover so you have some more awareness. We'd encourage you to go meet with a financial professional to go through this stuff in more detail. Working through some of the types of retirement plans that are available, 401ks are available to the majority of workers that are out there. 401ks at this time, you can contribute $23,000 per year, and if you're over 50, you can invest up to $30,000. The great thing about 401ks is that they typically are offered by employers who also provide matching. So say you contribute 10% of your income to your 401k, and then maybe your employer has an extra 5% match. So if you're contributing the full 10%, then what's being added to your 401k is really 15% of your income due to the match. Now, those types of programs are very generous, and they can help you build your 401k up more quickly. And a lot of professionals will recommend contributing to the max limits if you can, because then you'll get the full match and earn the most interest over time. Now, not everybody can contribute up to the limit, but earlier on in your career, you want to build this as quickly as possible so that as you get older and you have larger expenses, if you can't contribute as much, then the interest can compound and you can continue to build a nice retirement for yourself. Now, 401ks typically are limited to certain types of investments. There are different types of funds that you can invest in with a 401k, but it's typically not stocks. A lot of product offerings are not going to allow you to invest directly in stocks because they're considered risky and they want to make sure that you have this income for your future. Similar to a 401k, there's a 403b, which is essentially a tax-sheltered annuity. It works similar to a 401k, but these are tax-exempt when making withdrawals. These are typically limited to public employees like public school teachers, but they can also apply to employees of some tax-exempt organizations. Then there's the IRA, which is an individual retirement account. This is something that you're contributing to a lot of times with your employer. You can make contributions, but sometimes they don't have that additional matching like they do with the 401ks. The reason you would move to an IRA over a 401k is so that you can have more control over your investments. You can invest in stocks if you have an IRA, but the contribution limits are a little bit lower than what you see with 401ks. Now, there are also two types of IRAs that you can choose from. There's a traditional IRA, which uses pre-tax contributions and is taxed when you withdraw the money. And then there's a Roth IRA, where you're contributing your after-tax income and you only have to pay taxes if you go over certain withdrawal thresholds. And we'll talk more about the differences with traditional and Roth in just a moment. Before we move on, I just wanted to share with you some of the other savings plans that are out there. There's a 457, which is a plan similar to a 401k, where the investments are made pre-tax. And then there's also thrift savings plans, which are again very similar to 401ks, but are typically offered to government employees and members of the military. Now, I wish I could go into more detail about these programs, but I'm more of the math guy. I don't have a ton of detail about these plans, so rather than say something wrong, I just advise you to go talk with a financial advisor, and they can give you more detail. Most of your employers should have hotlines that you can call to set up a free appointment. Probably one of the most confused topics is traditional versus Roth when it comes to your IRA or now your 401k. There's not really a straightforward answer for which is better overall. It really depends on market conditions and certain assumptions that you're making about taxes. If you're making contributions pre-tax, you're assuming that the taxes you're paying when you take that out are going to be less than what you pay today. So if you believe taxes are going to be less in the future, then you want to go the more traditional path. If you would rather use after-tax money to invest to avoid taxes on your earnings in the future, then you'd prefer the Roth path. Now, in this example, let's say at 40 years old, you get a one-time $200,000 bonus from work for a kickback on a product that you helped develop. Using that as the baseline and assuming you're contributing 100% to your retirement plan, would you rather pay taxes now based on your income tax rate, or defer taxes until you get to retirement and you're able to withdraw the money? In the Roth, you'll have an upfront tax bill of $66,000 if you have a 33% tax rate, so you're starting out at $134,000 versus a traditional plan where your initial tax bill is zero and you start out with the $200,000. Assuming you accumulate interest for 20 years, then withdraw a reoccurring amount for 30 years, as if it's an annuity, in the traditional plan, you'll certainly end up with more in your retirement account, but as you go to withdraw the money, you'll be hit with taxes. In the Roth plan, you can still get hit with taxes, but it's not as likely. Either way, your after-tax take-home is about the same. So in this instance, it's just a matter of, do you want to be worth more, or do you want to pay less in taxes? Now, of course, this is a simplified example, but depending on contribution levels and having a different time period to accumulate the interest, the right decision for you could vary. As it relates to capital gains tax, for most assets that are held onto for more than 1 year, it can be anywhere from 0, 15, or 20% tax, depending on the asset type and the income that you made. Most investors in retirement try to withdraw less than the cap for 0%, but you also have to take Social Security payments into consideration, and if you withdraw too much, it can impact your payments, and you might end up receiving less or even having to pay back some of that if you're not careful. Now, keep in mind that those rates are just for holdings of more than 1 year. For assets that you held on to for less than 1 year, typically you're subject to your income tax rate, which can be considerably higher. In terms of balancing retirement and Social Security, what you need to understand is that if you have a large pool of investments and you're drawing Social Security, you can only withdraw so much from your investments before you begin to take a penalty on your Social Security benefit. Now, eventually, you're going to hit a point where you don't get any Social Security, or you have to pay it back because the withdrawals from your investments are so large that it nullifies the benefit. Now, what you see here is an individual with a $675,000 portfolio earning 8% a year. Now, as they make withdrawals, they'll pay a 15% capital gains tax on any investment earnings above $44,626 per year. That would mean that they receive about $52,594 per year. And over time, as those investments grow and their payments become larger, if the Social Security limits don't change, they're going to lose some of their Social Security benefit as their investment earnings surpass that upper limit. Now, depending on the income that you're making from Social Security, the limits start at $21,000 and go up to $56,000. So if your investments are making you above $56,000, an increase in income means losses to your Social Security benefit. Now, to me, this is kind of annoying because you earn the benefit by paying into the system your whole career, but that's beyond our control. So the point here just becomes recognizing that there is a penalty and not withdrawing more than the limits until your investments are making you above a threshold where losing all of your Social Security benefit would actually make sense. And if you think that you need that much money during your retirement, then you need to go meet with a financial planner to determine the best path forward. If you have large amounts of wealth, you already should have financial professionals that you're working with, but regardless, taxes and benefits need to be accounted for with retirement planning, and this is just something that most people never consider until they're ready to retire. Getting into mutual funds and hedge funds, what exactly are they? Well, in reality, they're all just funds. The word hedge came about later on, and hedging is just a strategy that most of them employ. Really, it's just a group of people that are pooling their assets together in order to exert more control over their investments. That way they can control certain outcomes a little more and make sure that they're getting returns for their capital. What you're typically doing when you're pooling your money together is you're buying shares in a fund, and then it's the fund that's using your money to invest in what they want. Now, doing so transfers the voting rights that would come from you owning the stock to the funds that are managing your investment. Now, that gives them power, and if you believe in your fund manager, then perhaps that's exactly what you want. The vast majority of folks aren't equipped to handle managing their portfolio, which is why these funds have been so successful over the years. So understand that most of the money behind them belongs to everyday folks like teachers, nurses, and tradespeople. Now, they get a bad rap because they're managed by these big firms on Wall Street, but they do exist in order to help out a lot of the middle class. So it's up to you whether or not you want to purchase their products. Most of you have employer-sponsored 401ks that are likely forcing you into certain mutual fund products. They aren't typically bad products, but you do have to pay attention to their performance and make sure you're putting your money in funds that are actually providing stable returns over time. It's a little like stock investing, and you really have to be careful which funds you choose and where you put your money because the losses are still possible. The last concept that I want to cover here is insurance. You can get insurance for some of these products, and there are insurance companies that are out there that can help you with this. Just like you would get insurance for your car or your boat or RV or something like that, you can get insurance for some of these financial products. Now, it's a way to help you hedge your bets in case something goes wrong with your investments, and certainly that's something that you can talk to your broker about or reach out to your insurance agent. I'm sure they'll be happy to tell you what sort of products are available to you and who can offer them to you. Now, keep in mind, most brokerage firm accounts are not FDIC insured like your checking account or your savings accounts. So if you're keeping money in a bank, your deposits are going to be FDIC insured up to $250,000 per account. But brokerages, certainly the stocks and the funds hold value, but in general, read the fine print and double check to see if they're offering any type of insurance on your deposits. Just make sure you're working with good investment firms because if they go belly up, you can lose your money. Find yourself a good insurance agent and work with them so you can figure out what's right for you and your needs based on the level of investments that you're holding. Now, if you're sitting on a portfolio worth $2,000, then maybe this might not be something that you really need. But if you're investing $3 million, then yeah, go sit down and talk with financial advisors, financial planners, and insurance agents to figure out which are the right products for you. All right, so let's take a moment here for another question. What's the difference between a traditional and a Roth account? Is it A, traditional is after tax and Roth is pre-tax? B, traditional is through your employer and Roth is not? C, traditional is pre-tax and Roth is after tax? Hopefully you were paying attention and you know that it's C, traditional is pre-tax and Roth is after tax. The last chapter for this lesson is over maintaining wealth. Now, at this point, we've walked you through stock investing strategies, hedging, and different types of retirement plans. But what we haven't discussed is how people actually maintain their wealth. Now, trusts and trust funds are one of the more popular ways to maintain and transfer wealth from one generation to another. So, by creating a trust, you're creating a legal entity that has certain obligations to the beneficiary, and it helps shelter you from a variety of different things. There's a little graphic here from a comment a few years ago where a famous politician in the US said that corporations are people. And that understandably upset a lot of folks, but what he was referring to is their legal status. And he's right. Corporations are viewed as people from a legal standpoint, which is just kind of the intention of establishing a trust. It helps incorporate your wealth and provide it with more legal protections. You also don't have to name beneficiaries, and the beneficiaries can change over time, so it offers other types of privacy protections as well. So if you're an individual that has a larger amount of wealth and you want to be able to maintain that over time and provide it with future protections, consider talking to your advisor about establishing a trust. The last concept that I wanted to talk to you about is what I'm calling expense funds. And this is how to live off of your money if you have a larger amount and you're trying to figure out how to manage it all. For example, if you like to spend $1,000 every 2 months on some of the finer things, like maybe it's a spa day or a facial or getting your hair and nails done, or maybe it's a trip to a sporting event, or maybe you even want to go out to like Las Vegas and gamble for a weekend. Whatever that is for you, what I'm getting at is that you like to spend money on that every few months. So it's fair to assume that in retirement, or if you have a large enough amount of money to live off of, that you're still going to want to cover those expenses. So how do you have your investments generate that money for you so that you don't have to contribute anything, and every few months you just automatically have that money available to you to spend on those activities? Using this example, spending $1,000 every 2 months is $6,000 per year. And if your investments are, in general earning an 8% annual return, in order to produce that $6,000, you need investments worth $75,000. So by only spending the interest off of that account, those activities will now have no negative impact on your wealth. Taking a broader perspective on that, say you have $5 million and you want to figure out how you can manage that while paying your bills and still being able to grow your money in your investments. What you can do, and this doesn't have to be in separate accounts, but it can be if it makes it easier for you than keeping a ledger. What you can do is segment out $500,000 in a fund for housing and utilities, $250,000 for food and entertainment, $125,000 for travel and leisure, and $125,000 for healthcare and charity. Now, assuming an 8% annual return, for housing and utilities, that's $40,000 per year or $3,300 a month. For food and entertainment, that's $20,000 per year or $1,700 a month. And for travel and leisure, it's $10,000 per year or $833 a month. But just kind of a point here, $10,000 a year for a vacation, especially if you're in your retirement and it's just you and your significant other, that's a really nice vacation. And then when it comes to healthcare and charity, everybody is going to have some level of healthcare expenses. And for many individuals, charity is a big part of their life, whether that's about giving back, helping others, or fulfilling like a moral or religious duty. There are many reasons why we should all consider participating in charitable activities. Then ultimately, going back to your total net worth, these amounts here add up to $1 million, meaning that you would have $4 million remaining for your investment fund. And using the same assumption that you're earning an average 8% annual return, that's going to earn you $320,000 per year. And if you're just reinvesting those earnings, after 5 years, you're going to have $6 million, and it will continue to grow from there. So you will want to adjust your expense funds for inflation, but maintaining that balance while continuing to grow your investments will put you in a position where taking advantage of trusts and trust funds now become a necessity. Essentially, it's just taking advantage of the idea that you're only spending your interest and you don't touch the principal. Of course, this could look quite different based upon your priorities, but hopefully this inspires you to think about how you would do this. All right, so let's take one more break for our final question. And this question is, what is the difference between a bid price and an ask price? Is it A, a bid price is what others want you to pay for a stock, and an ask price is what you're willing to pay for it? Is it B, a few cents? Or is it C, a bid price is what you're willing to pay for the stock, and the ask price is what others who own the stock are willing to sell it to you for? So obviously, this is one that we haven't covered yet. The answer is C, a bid price is what you're willing to pay for the stock, and the ask price is what others who own the stock are willing to sell it to you for. We'll cover bid price and ask price in more detail when we get to Portfolio 600, Getting Started. To recap this lesson, hopefully having covered the results of our testing, going through day trading concepts, hedging, liquidity, the basics of taxes, retirement, Social Security drawing, and maintaining wealth has you leaving with a little more confidence and a better understanding of how to plan your strategy and what to watch for when building and maintaining your wealth. All right, that's it for Portfolios 400, Investment Strategy. Be sure and stay tuned for our next lesson, Portfolios 500, where we cover basic economics in an effort to help you better understand the market. Until next time, I'm Matt Franklin. Thank you for being here, and have a great day.